Hello, my name is Leighton. Today we'll look at the tax implications surrounding something that was paid for in this year but is used in the next. This will be called a prepayment, and I'll be discussing these implications for small business entities. General deductions are classified as an expense that has incurred by the business when they are made to produce income. Even if this expense doesn't produce income itself, an expense can be deductible if it's a part of the necessary business operations to produce income. There are expenses that are explicitly excluded: private expenses such as personal clothing or groceries, and capital expenditure such as equipment purchases and renovations. Prepaid expenses are incurred when an agreement is made for something that will be provided in part or in full in a later income year. These expenses must be deductible, as previously described, to gain tax benefits. Insurance would be an example of a prepaid expense. It's usually bought in yearly packages, and the benefits being provided over the year it has been paid for. This is also true if rent is prepaid for an agreed amount of months. Now that we know what a general deduction and a prepayment is, we will look closer at the conditions required for a prepayment expense to be considered for an immediate deduction. If the expense isn't already considered a deductible expense, there is a potential for two more options to apply, these being excluded expenditure and the 12-month rule. An immediate deduction is beneficial for businesses since it reduces taxable income sooner. This means the business will pay less tax in that year, which improves cash flow. We first need to look at the prepayment period. The ATO has established a criteria, which is shown on screen, to determine when the prepayment is deductible. For context, the income year for tax purposes starts the 1st of July to the 30th of June every year. I'll give an example with the timeline on screen. I purchased 12 months of rent on the 25th of June 2026, but I'm not allowed to move in until the 1st of July that same year. The prepayment was paid in advance, so the prepayment period would start on the 1st of July, which is the date you're able to move in. So this is where the timing comes into effect. You paid for the prepayment in the 2025 to 2026 income year. The prepayment period occurs during the 2026 to 2027 income year. This means you would not be able to claim the deduction in the year you paid for it, but you would be able to claim that deduction in the next year if this deduction is allowable. In regards to the end date, given this rent period is under 10 years, the prepayment period would end on the 30th of June 2027, which would be the move-out date. The ATO established the 12-month rule to assess prepayment timing. Those applicable are shown on screen. I'll show the criteria by running through an example scenario. If I pay for 12 months rent on the 1st of June in 2026 starting on that day, being equal or less than 12 months, this satisfies the first requirement. Since this prepayment period ends on the 31st of May 2027, it is still within the next income year from when the prepayment period started. Remember, the income year ends on the 30th of June. This will satisfy the second requirement and will make this expense eligible for an immediate deduction for the 2025 to 2026 income year. If I had instead paid for 14 months rent starting on the 1st of June 2026, the first requirement does not pass, so an immediate deduction is not available. If the 12-month rule isn't satisfied, meaning the eligible period for the prepayment expense continues after the next income year, or is longer than 12 months, the expense will need to be split up over the shortest of either the lifespan of the eligible period or 10 years. There is a formula provided by the ATO to determine how much of the prepayment is allocated in each year. I'm not going to go through the maths on this one, but I've got the formula on screen. It basically ensures the prepayment allocated to each year is what's used during that income year. Excluded expenses are another consideration for an immediate deductible, just like we went through with the 12-month rule and the general deductions. The conditions to satisfy the excluded requirements are listed on the screen. If any of these capture an expense incurred, we can consider it an excluded expense, and therefore it would be immediately deductible. To conclude, prepayments are about timing. If the benefit lasts no longer than 12 months and finishes within the next financial year, the prepayment can be claimed immediately. If it extends beyond this, the deduction must be spread over the period the service is used. Understanding these rules will help improve cash flow and taxation planning decisions.